Well, good afternoon, everybody. My name is Manny Punbongsa, Head of Sales at Brompton Funds. And today I'm joined with my colleague, Chris Cullen, Head of ETFs. I want to say on behalf of Brompton, thank you very much for taking the time to join us this afternoon. Today, we are excited to be talking to you about our Brompton suite of Cash Flow Kings ETFs. And the premise behind these ETFs is to invest into the highest free cash flow yielding companies. Now, these companies are not only able to generate the highest free cash flow, but we're able to select them at very attractive valuations. These custom ETFs will offer low pricing at about 45 basis points management fee. And we're going to offer diversification, which excludes financials, which is about 30% of the TSX, as well as seeking to avoid expensive tech stocks, which is about 30% of the S&P 500. Our rebalancing feature allows us to always generate and select the highest free cash flow generating companies in eligible sectors. And we've run the models over the past 10 years. And what their model suggests is free cash flow yield factor is a superior metric to long-term outperformance. We offer the Canadian version, US, which has been live for the last month. And KNGX, we're happy to report that we're going to be trading and live tomorrow. Now, before I pass it on to Chris Cullen, I just want to take a look at the overview of what's been happening in the market. What we've seen is unintended tilt towards growth. Now, we all know growth has significantly outperformed value over an extended period of time, and it's quite evident with the S&P 500, particularly this year. Taking a look at the Magnificent Seven, they account for about 32% of the market cap of S&P 500 and is attributed to about 60% of the S&P's return this year, with the S&P 500 being up north of 15%. Now, this data is as of June 30th, so clearly lots have happened over the course of the last couple of days. But at the same time, the equal weight S&P 500 has only returned 5.1%. So we have to ask ourselves, is this top-heavy concentrated performance something that could be replicated? Or do we believe there's a better way to invest into equities, knowing that we continue on with this long-term growth over the next decade? And we believe we have something with Cash Flow Kings. Now, I know it's only a short period of time, but since the CPI print came out on July 11th, which reiterated the fact that rates will be cut later on this year and following through into 2025, what we saw was a reaction with the Magnificent Seven being down 3%. But at the same time, the broader market had rallied. Other sectors had started to get a bid. Now, I by no means am saying this is the actual pivotal date of this great market rotation that we've all been talking about. But at the same time, what if it is? Or what if this is just the beginning? Because we have seen broad participation on the remaining 493. We've also seen the Dow Jones Industrial Average deliver some pretty decent returns in times of market volatility that we've seen recently. Cash Flow Kings, the US in particular, investing in the highest free cash flow yielding stocks, was a direct recipient of that. In fact, it was up 3% the following day on July the 12th. So we believe, and based on the historical data that we have, along with the composition of the portfolio, we believe that Cash Flow Kings will participate in the broadening of this equity rally, and we believe we're well positioned into the coming years ahead. And so with that being said, I want to pass it on to Chris Cullen to talk about free cash flow, the importance of it, and why free cash flow yield is a superior metric over other factors of investing.
Great points, Manny, especially with all the large prominent chip stocks down 5 to 10% at the open this morning. So just to continue these thoughts, this ETF is based on free cash flow. I don't think that this concept is so new that anyone in our audience would be that unfamiliar with it, but I'm going to give it just a recap as to why we like free cash flow. Strong free cash flow, what it does, it really gives a company options to create value for shareholders. We're kind of agnostic to all the different types of ways that these companies can create value for shareholders. We just know that we want companies with the highest free cash flow yield that are going to be the most impactful for shareholders and drive prices higher. So when a company has free cash flow, it has options for growth. There's internal investments such as starting new R&D programs or taking on a new product line, companies can internally fund those opportunities. There are M&A opportunities. Companies that have high free cash flow yield are both able to acquire other companies. They're able to take on debt and to fund those acquisitions through internal cash flow, or they may represent attractive acquisition targets because they are generating such high levels per the capitalization. Companies that have high free cash flow can also return capital to shareholders. They can pay dividends and they can grow their existing dividend stream. They can also do activities that improve balance sheets. They can reduce debt, or they can buy back stock and increase EPS that way. So free cash flow is fantastic as a focus for an index and as a focus for ETFs, just because of the flexibility that it gives to those companies that are generating it. Not only are we focused on free cash flow, but I want to highlight and stress that this index-based strategy for the US, Canada, and international is focused on companies that are generating the most free cash flow for the least amount of investment. And so what we're doing is focusing on the highest free cash flow yielders. So the free cash flow that they're generating, it's cash from operations minus capital expenditures. It's what's left over after the company has paid for all of its input costs, paid its bills, reinvested in its existing plant and equipment, and it's cash that's left over and it's available to create value for shareholders. We're dividing that free cash flow amount by the enterprise value of the company. Instead of the market cap, we're including market cap, obviously, and enterprise value. That's just by definition part of the enterprise value of a company. But companies are funded with many different types of capital, and companies in different sectors take on different conventions for how they fund. So we're going to include all of it. Enterprise value is just market cap of equity, debt, preferreds, minority interest, and it subtracts cash. And that just includes the value of capital invested in the company from all sources. So when we take those two numbers, we divide free cash flow by the enterprise value. That's the number we're focusing on. Free cash flow yield is just simply that. Highest free cash flow for the lowest amount of capital investment. And those are the best bargains to be had in this index. So a little bit on what that looks like when you take that focus and construct an index. Free cash flow yield is a better way, we think, to measure value in companies than most traditional value metrics. So we're going out with the moniker that it's more value than value. Free cash flow yield is universal, it's objective, and it's very relevant to valuations. If you look at traditional metrics like price to earnings or price to book value, not as reliable. Earnings are subjective. It depends on the type of accounting positions that a company's finance team takes, and it may vary across different companies that have very similar results. So not 100% reliable in terms of figuring out valuations. Price to book is problematic also because book values can be old. They can reflect costs for replacement of assets or of intellectual property that are past their best before date. Replacement value might be much higher. So not as reliable, and also just the fact that different sectors have different conventions for different capitalization structures make it difficult to compare those metrics across sectors. Free cash flow to enterprise value clears away these problems, and it focuses on cash and total capitalization. And so it's comparable across sectors and across companies. Not only that, but focusing on free cash flow yield provides superior returns versus traditional value or just broad indices over every performance period that we've looked at, 1, 3, 5, and 10. Our back-tested Canadian and US Cash Flow Kings indices dominate returns over value and over the S&P 500 and the TSX Composite. So you can see also that on most metrics, most traditional metrics, price to earnings or price to book, just focusing on free cash flow yield gets you a very attractive portfolio relative to just using those traditional metrics, and get you a higher free cash flow yield, obviously, because that is the focus of these indices. Manny had talked a little bit about, are we looking at a pivot right now in the markets, and could it be time for leadership in tech to be replaced by a broadening of the market rally? Well, here's another proof point really to that idea. As of yesterday, the S&P 500 Growth Index price to earnings multiple was 38.4%. So it's quite high on an absolute basis when compared to history. And the S&P 500 Value Index price to earnings multiple was 17.3 times. We took every year that Bloomberg had available over the last period. We have 23 and a bit years of data that Bloomberg was able to produce for us of the price to earnings multiples for the growth and the value index for the S&P 500, and that's all charted in that graph on the right side of the page here. And we're charting the spread between those two multiples. So right now, what we have is the 38.4 for the growth index minus 17.3 for the value index. That gives a spread of 21.1 times. So that's the difference between the valuation on a PE basis between those two indices. What we're finding is that this is an astronomical level compared to all the data that we were able to produce over, since 2001. 21.1 times puts us far beyond the 99.9 percentile. You could add 3 or 4 more nines there, actually, but it started to look over the top after I started typing out all those nines. So this is a pretty much the absolute high point for the spread between earnings multiples for the growth and the value index. And these things correct. The average over the last 23 plus years is 4.9 times spread between growth and value on a PE basis. So we can't call a market shift like this, but it would make sense if investors started to look for better value. And Cash Flow Kings is a rifle shot at value. It's a highly reliable value metric. We expect our indices to benefit greatly if this shift does come to pass. Here's another discussion on Cash Flow Kings. We talked about M&A activity for high free cash flow yield companies. And since we listed just on June 3rd, we only listed the Canadian and the US ETF so far. Tomorrow is the listing date, July 18th, for the international version, KNGX. But since listing KNGC and KNGU, what we've had is 3 holdings that have been the targets of acquisition activity, either closing a previously announced acquisition or announcing a new offer from a buyer. 2 of our holdings in the Cash Flow Kings indices have been the acquirers. So what this means in my mind, and I think it should mean in your mind, is that high free cash flow yield makes for very attractive acquisition candidates, makes for very willing and able acquirers for the right situation that are able to finance the acquisition. So this is an illustration of the flexibility that free cash flow yield gives in terms of building value through M&A activity. Just to review quickly, Stelco, this was just 2 days ago or 3 days ago. They received an offer from Cleveland Cliffs that was an 87% premium to the closing price the day prior to this offer being announced. So very, very impressive premium to that price. The target is part of our Canada Cash Flow Kings index, and the acquirer is a constituent in our US Cash Flow Kings index. So meeting both the criteria for an attractive acquisition and an able acquirer. There we go. Enerplus closed just as we were listing, the Cash Flow Kings ETFs. That was a Canadian target and a US acquirer. Both of those were in our respective Cash Flow Kings indices. Cord Energy is a Cash Flow King, as was Enerplus. Enerplus is gone now. The acquisition closed about a month and a half ago. That offer premium was a 14% premium to the previous closing price. Marathon Oil was announced just as we went to listing, just as we struck the index at the end of May. ConocoPhillips made the offer for them, 15% premium to the previous closing price, and Marathon Oil is one of our Cash Flow Kings. ConocoPhillips did not make the screen, but I think that this is just an illustration that in 6 short weeks we've seen 3 companies create value for the Cash Flow Kings indices and for our clients who are invested in the ETFs through M&A activity. I'm not going to read out this quote to you. This is just a quote from Warren Buffett, and the main point here is that we are not the only fans of free cash flow out there. Warren Buffett is known as a value investor and is highly focused on cash flows. And we think that that's a great recommendation from a storied investor.
You know, Chris, to add on to that, when you think of the different common factors that are used by portfolio managers and passive indices, whether it ranges from value to high dividend, dividend growth or growth, in one form or another, a lot of these companies are selected based on strong management, healthy balance sheets, and ultimately companies that are able to generate high free cash flow. And the beauty behind this free cash flow yielding metric behind our ETFs is that it cuts out all the noise and it gets right to the nucleus. In fact, the data that suggests over the past 10 years in the US market, the left axis is the annualized performance and the bottom is the number of months of outperformance over the index. What this implies is free cash flow yield is a superior factor, not only being able to deliver outperformance over the past 10 years, but also deliver performance in more consecutive months than that of the most commonly used factors out there. To continue on with that, here you can see the free cash flow yield models in Canada and US delivering long-term outperformance over the S&P 500 as well as the TSX over the past 10 years. Now, what stands out in the US model is that this outperformance is actually with limited high valuation tech exposure, which we all know has dominated the performance of the S&P 500, especially as of recent. And at the same time, what's just as impressive is the Canadian model outperforming the TSX with its lack of financials, which number one gives you diversification, but also the fact that TSX's market is very concentrated in terms of its sector exposure. The models also have proven to be resilient in times of market volatility. What we saw in 2022 was the fastest rate hiking cycle in history. And yet both the Canadian and US models, although they weren't immune to the volatility, they were able to recover from the previous peak in a much shorter period of time. In fact, 12 months later, both strategies were able to outperform the respective benchmarks significantly following 12 months. And that's because in times of uncertainty, I think it's fair to say that the market naturally gravitates towards high quality companies. We're looking for strong balance sheets. We're looking for companies that are able to generate free cash flow. And in a high inflationary environment, which we've seen as of late, in fact, these will be the direct recipients to be the benefactor of higher rates because they're actually being rewarded with higher rates as opposed to having to finance their projects at a higher rate. And so this is the backbone behind Brompton's suite of Cash Flow Kings ETFs, which focuses on companies with the highest free cash flows. But that's the thesis and that's the backdrop. I'd like to pass it back to you, Chris, for you to talk about the portfolio construction and the constituents and how we're able to position the portfolios.
Sure. I'll just keep a little or have a little bit of a focus on correlations here. And what we'd like to just point out is that both the US Cash Flow Kings Index and the Canadian Cash Flow Kings Index exhibit less than perfect correlation to the broad indices, and especially to the growth style of the indices that are available in Canada and the US. In the US, we see about 80% correlation to the S&P 500. That's a pretty good correlation, but it's certainly not perfect. You're going to get a little bit of really hedging it if you hold the S&P 500 and our Cash Flow Kings ETF, just in terms of they won't always perform in the same manner, and it'll smooth out client portfolio returns. Less so in terms of correlation to the growth index or the NASDAQ 100. So this just highlights some of Manny's points earlier that this backtest performance, which has been stellar, has been done without the benefit of a high correlation to a large cap technology such as has the S&P 500. In Canada, kind of a similar story, except for the financials, I think, is the biggest gap between what the Brompton products are offering and what the S&P TSX offers. Quite low correlation for equity products to the financials, and yet high levels of outperformance of the S&P TSX composite. Let's talk just for a bit to give an overview of how the indexes are constructed, and then we'll look at some high level data on the portfolios that are produced. So follow the money is the title to this slide, and that's really a one-sentence summary for what the indexes do. We start, number one, with the universe definition. There are, among the different indices, different levels of market cap and liquidity minimums. So we screen out companies that aren't large enough or aren't liquid enough to participate. One thing I want to highlight again is that this universe does exclude financials. Free cash flow for financial companies, just to kind of put it in a nutshell, is difficult to use as a valuation metric. These companies use cash and use debt in a different way that other companies do. Many companies have cost of goods sold. Cost of goods sold for a bank, for example, would be the interest paid on borrowed money that they use to extend loans to clients. So it messes things up, and it makes it not easily comparable between financials and other sectors. So we've excluded those. The second step that we do is we select constituents, and it's simply by calculating the highest free cash flow yielding companies that make it into the universe. And we select for the US and starting tomorrow for international, the 50 top highest free cash flow yielders. For Canada, since it's a somewhat smaller market, we select 35, just to make that a more concentrated part of the Canadian market. So constituents are selected on free cash flow yields, and then they're weighted. They're not weighted by free cash flow yield. We don't want to get in the situation where one of the smaller companies in our universe has the highest free cash flow yield, and so we weight it the highest. It just wouldn't work very well from a liquidity perspective and a trading perspective. So instead, how we're weighting is we're using the 12-month trailing dollar amount of free cash flow. We're weighting according to the aggregate value of free cash flow. So that what that does is that puts larger cap, more liquid, more sizable companies in the largest positions in these indices. All these constituents, by the way, are subject to maximum weightings, and we can go through that in the next few slides. But this very simple process produces the Brompton Index 1 Cash Flow Kings indices. So Canada and US, which are already subject to an ETF and already listed and trading. And starting tomorrow, we have an international version of the free cash flow ETF, KNGX, which we'll list on the TSX.
And Chris, if I could just quickly jump in to elaborate on your comment about free cash flow yield relative to the weighting. Mm-hmm. If you take a look at the US constituent, obviously we're looking for the highest free cash flow yielding companies, but we rank them and weight them based on the dollar value of free cash flow. And the one company that stands out is HF St. Clair Corp, which is about 2.7% of the overall portfolio. Its free cash flow yield is just shy of 16%. However, the market cap's only 10 billion, and the free cash flow is only 2 billion relative to Bristol Myers at 12.5 billion. And so we wanted to move those with higher free cash flow dollar values up the ranking to add liquidity, more opportunities. And it's just to reiterate and show as a clear example of the portfolio construction and the prudent asset allocation that we considered.
Fantastic, great point, Manny. So this is the top 15 constituents from the May 31st rebalance of the U.S. Cash Flow Kings Index, and you can see there's a good distribution between different sectors. Nothing is too overweight in this U.S. portfolio. There is some allocation to technology, just over 20% allocation, versus the S&P 500 has about a third allocation, and that allocation in the S&P 500 is a very different profile than what we would have in the Cash Flow Kings Index. We can see companies such as Gen Digital and Hewlett Packard. A couple of versions of Hewlett Packard here actually as part of the information technology allocation. This is really value infotech rather than some of the high flyers and the very high earnings multiple technology companies that dominate the S&P 500. And you do get a very nice profile in terms of market cap. These are good sized and liquid companies that are being included in the Cash Flow Kings indices. 9.9% overall free cash flow yield for the index constituents. That's versus 2 to 3% for the S&P 500. So overall, this index is doing what we've designed it to do. This is a very dynamic strategy, and I think that this slide illustrates that. What we're showing on both on the left and the right is sector allocation through time. So every quarter for the last 10 years for the US Cash Flow Kings Index on the left and for the S&P 500 on the right. The S&P 500, you'll note, is almost static. I mean, there are fluctuations over time, but it's mostly driven by market cap, or as you can see in 2019 on the at the bottom for communication services, sometimes there's a reassignment between GIG sectors into other categories that affect the weighting of a particular sector. But for Cash Flow Kings, following the money, they're every quarter we're reassessing the market, the entire market. We're finding the big companies that are liquid, that have the highest free cash flow yield, and we're reallocating capital to those very efficient, capital efficient free cash flow generators. And so this is the point of these indices, that it's meant to be dynamic. It's meant to find value in terms of free cash flow to enterprise value where it lies. And we make no bones about this. This is a dynamic indexing strategy. And it's also very successful in terms of total returns. What we have here are standard performance, 1, 3, 5, and 10 years. Our US Cash Flow Kings Index beats the S&P 500 in every standard performance period. The correlation is less than 100%. It's less correlated than most large cap equity strategies, so 79.5%. And we see some, although the US Cash Flow Kings Index comes out the winner in most annual returns periods, we do see some jockeying back and forth as time goes on. And this is to be expected just because of the nature of the low correlation between those two indices. Now, Canada, let's turn our attention to our Canadian Cash Flow Kings Index. This, again, is May 31st, the rebalance date of the Canadian index. You'll see that energy is a large component. Energy is just a large component generally in Canada. And when you knock out the financials, it's I believe it is the largest component of the Canadian capital markets. We are capping any one sector exposure to 40% in the Canadian version of our Cash Flow Kings Index. That is just to manage risk and manage overexposure. There was one point in the last several years where the model, if it didn't have a sector constraint, would have called for 70% energy, and we don't think that's what we want to deliver to clients. We want to deliver value through free cash flow yield, and we want to deliver diversification among sectors as well. So quite well diversified. We're at the max energy level right now, and that's just the nature of free cash flow yield. When energy is spitting out the highest free cash flow yield, this ETF will gravitate towards it. But we do get lots of large and recognizable companies in the Canadian sector, and you can see again that if we weighted by free cash flow yield, Air Canada would be among the top here. I believe it is the top free cash flow yielder in this portfolio, but it certainly would not be the most material in terms of market capitalization. So our weighting by trailing free cash flow is giving us what we're looking for here: liquidity and large free cash flow yield numbers. Index weighted average again is up near 10%, 9.3 versus 2 to 3% for the S&P TSX Composite. And again, demonstration of the dynamic sector allocation. The light blue sector at the top of the S&P TSX Composite Index sector graph at the right is the financials, and so you can see that's missing from our Brompton Index 1 Canadian Cash Flow Kings Index, which is quite remarkable that it's been able to perform so well since financials have been such steady performers in the Canadian market. But this is the power of free cash flow yield and dynamic sector allocation. As opportunities present themselves, the index gravitates towards them regardless of sector. And here we go for performance again. It's been on a one-year basis. We're seeing about neck and neck between our Cash Flow Kings Index and the S&P TSX Composite Index. As far as 3, 5, and 10 years, strong outperformance, and we have a similar type of situation in terms of the annual performance. When growth becomes more in vogue for the S&P TSX Composite, it may slightly outperform. When value comes back in, well, that's when our Index 1 Cash Flow Kings Index really powers ahead. And so great results from a lesser correlated index, and again, great consideration to hold our King C beside your S&P TSX investments. And finally, here's a little snapshot of our new index. I think I mentioned it, but if I did not, I will mention it now that many issuers in the international developed markets that this ETF is focusing on and this index focuses on. There's 21 international developed countries that we'll be selecting stocks from. But many of those issuers report on a semi-annual basis rather than on a quarterly basis. It's not completely convention to report on a quarterly basis globally. So we are rebalancing semi-annually for the International Cash Flow Kings Index. And we took a snapshot. The last rebalance date, well, the rebalance dates will be February and August. We're launching mid-July. So we're using the February rebalance. And this kind of summarizes, just based on current numbers for trailing free cash flow yield, what are the biggest free cash flow yielders? That's how the ranking works here. You can see that, you know, for example, the highest free cash flow yield would be Centrica in this group, and it wouldn't be among the highest market cap companies. So ranking by trailing free cash flow is the way to go. This portfolio will launch on these names, and it'll come up for rebalance in August, at which time we'll assess the current numbers and reset the portfolio holdings. The index sectors and countries, you know, again, we're seeing some good diversification. Nothing hit the 40% sector cap in the international index as of now. And so good distribution between industrials, energy, and all the other sectors that are out there. There's a little bit of tech, but tech is quite expensive internationally right now. Countries are also subject to a maximum. 40% was the maximum there as well. We don't hit that on any single country currently, but Japan is a bargain. United Kingdom is looking quite cheap currently. Lots of big and reliable free cash flow generators in those countries, and all the other ones internationally that we're focusing on. So this gives a summary of the high-level features of each of the as of tomorrow, each of the three free cash flow Kings ETFs that we will have listed. Brompton US Cash Flow Kings, KNGU, 45 basis points management fee. We're looking at low competitive fees. For Canada, we've got 45 basis points as well. International is a little trickier, so we're charging 55 basis points just in terms of dealing with all the currencies and all the accounting conventions and all the reporting periods and that kind of thing. There's a bit more work involved there. I think it's a bargain to charge 10 basis points more. For each of these distinct geographies, we're focusing on mid and large cap stocks. There is no liquidity screen for the US as long as companies there meet our market cap minimum. The US is the largest and most liquid market in the world, and we didn't find that we needed it when we ran our back tests. For the Canadian market, we're focusing on the top 150 most liquid stocks that meet all of our other criteria. For the international developed markets, our universe is composed of the top 500 most liquid stocks. As far as the portfolios or the index constituents go, US and international will focus on the top 50 stocks. They're big enough markets that 50 is quite a rarefied slice of those markets. For Canada, because it's a smaller market, we're focusing on the top 35. The maximum weights fall out accordingly. 4% max for international and US, 6% for Canada. Sector caps apply to Canada and international, 40% max. And country cap, the only one that needs that is the international index and the international ETF. And then I mentioned this already, quarterly rebalancing for Canada and US, and that's just due to the quarterly reporting convention we have here, and semi-annually for international stocks in line with the reporting convention.
Thank you very much for the recap. For those of you who are on the line, if you have any questions, feel free to ask questions through the Q&A box. But in between that time, as we're waiting for questions to come through, Chris, maybe I could pass along some questions that myself, along with our wholesalers, have received from some of our advisors out there. In particular, you know, in the selection process, does Kings take into account the dividend yield of the underlying companies, as well as further screening?
The answer to that question, Manny, would be no. That's because dividend yield falls out of free cash flow. And we're agnostic as to whether the company pays out its free cash flow in terms of a dividend, whether it repurchases stock in the market to increase EPS, whether it uses that free cash flow to create value in other ways, either through internal investment or M&A. And so, no, this is not a dividend strategy. This is actually it's kind of one level up from a dividend strategy. It's more of a meta strategy that focuses on the basis for paying dividends, or the basis for improving your balance sheet, which is free cash flow yield. Hopefully that answers the question.
Mm-hmm.
Do you want to we have several here that talk about why did KNGU come out of the gate and drop a little bit as the S&P 500 went to higher and higher highs. Is that one you want to try, Manny, or you want me to try that one?
No, you can go ahead.
Yeah, sure. Well, as I think we made clear, free cash flow yield is something like a value strategy. In fact, it's a superior value strategy to most traditional value strategies offer. And what we've seen in large part for the last 18 months or so is growth leadership in the market. The free cash flow index has done okay, has done quite well actually during this growth period. But growth kind of accelerated in the last month, 6 weeks, something like that, up until it hit a bit of a roadblock earlier this week and last week. So again, our KNGU did drop a little bit as it came out of the gate in June, and that reversed, and it's climbed quite steadily since then. And again, look at today's action as far as some of the large cap high-flying AI tech type stocks go. This could be the time for KNGU and KNGC and KNGX to shine. So that would be the explanation. It's a really a growth versus value concern. The similar answer to another question that we got back, which was what happened in the 2 down years for KNGU. There were a couple of down years for KNGU, and this is not a guaranteed always go up, helium-filled strategy. This is out there grinding it out and looking for the best value in terms of free cash flow yield. We had some years that have had strong growth leadership and negative performance from value. And while our strategy, our index strategy, had done well compared to other value strategies, there's going to be some years that it's not leading over growth. However, over the long term, this has been truly a winning strategy. Let's see here. I think there was another question about.
Chris, I'll address a question that a lot of the wholesalers, including myself, come across out on the field.
Yeah.
And that is the rebalancing feature.
Mm-hmm.
As great as it is, always looking to select the highest free cash flow yielding companies, how much turnover does this create? And at the same time, is this beneficial for the overall portfolio? And maybe I could take that on. These are passive ETFs, and our models are always selecting companies that are able to generate high free cash flow at attractive valuations. But even though they're passive ETF, there's a lot of activity that's involved. And if you could reference that one slide pertaining to the dynamic sector allocation, you can clearly see the shift in allocation. Quarter by quarter, we could always feel comfortable knowing that we are going to select the highest free cash flow yielding companies. Now, it might not necessarily work out that particular quarter, or maybe even the following quarter. But what we do know is over an extended period of time, it does deliver long-term outperformance. At the same time, let's address the original question. There's no denying the rebalancing on a quarter-by-quarter basis will create activity, which will be more turnover than the average portfolio. And if we had to take a guess, it would be anywhere from roughly around 20 to 25% of the overall portfolio quarter by quarter. But time will tell, and we'll be able to see how things play out.
Yeah, this is, by the way, just to highlight, it's not much different from many quant strategies or many fundamental index strategies that take a new measurement every quarter and reset their portfolios accordingly. And about 100% per year, that's about right, 25% per quarter, according to our back testing.
And maybe, Chris, I could just pose this last question on to you, unless there's other questions out there on the webinar. But I mean, this is the biggest and brightest and shiniest thing and the best concept ever, Chris Cullen. How come nobody's launched it over in Canada? Why is Brompton the first to launch it over here?
I'd say because we're geniuses. No, I'm kidding. It's we're I think we can recognize good ideas, and there has been a suite of free cash flow yield ETFs launched in the US that has had some good success, both in terms of returns and in terms of kind of addressing investor needs. And this is the first of its kind in Canada. Pacer is the company that launched in the US. You don't just leave everybody hanging on that. Their cows product. We think that Canadians deserve the benefit of this kind of strategy, low cost index approach to buying equities on any geography that you like worldwide, as long as they're developed markets, and focusing on this very effective value metric. We've done it a little bit differently than the Pacer people have. We have a more concentrated portfolio. They tend to focus on 100 stocks for each of their mandates, and we're focusing on 50 or 35 in the case of Canada. And so what we get is a more pronounced kind of impact of the free cash flow yield factor. When you look at the back test, we do slightly outperform the actual performance of the cows product versus our US index over the time period that cows has been listed. And the other benefits for Canadians obviously are avoiding messy tax issues, estate issues, that kind of thing, of holding US listed products. So yeah, this is we didn't invent this idea, but we were the first to bring it to Canada, and we think it's great. So I hope that after today's session that all of our viewers agree.
Excellent. And one last question we just got from the field here. Can you speak to expectations for correlation or relative volatility metrics of Cash Flow Kings ETFs?
Yeah, we'll go back to the correlation chart. We expect historical correlation to be somewhat, you can never expect the future to be the same as the past, but we expect it to be somewhat in line. And for Canada, certainly, we've got a decent correlation, 85%, but it's not perfect. And that would be because of the exclusion of financials, and then just in terms of correlation to growth, it's even more pronounced as far as being differentiated. For the U.S., if you look at the U.S. Cash Flow Kings Index versus the S&P 500, you got a pretty similar story. It's 80% correlated and 62.5% with the NASDAQ 100. So quite differentiated from a growth strategy. As far as volatility goes, this product is rated. Both of these products for Canada and U.S. are rated medium high risk. That is driven off volatility. The volatility for the 10 years up until when we filed the ETF facts in May was approximately 17%. So that's on the lower end of medium high in terms of how our regulators require us to rate these sorts of things for our ETF facts documents. The S&P TSX would be somewhere in the 14 to 16% range. I couldn't give you the exact quote right now. So there's slightly higher volatility. A lot of that is driven by the fact that this is a concentrated kind of shot at the free cash flow factor. So that does introduce slightly more volatility. But again, we thought that when we assess this overall as a whole, that the superior returns profile really outweighed any concerns we might have for volatility. I'll just put this up for the Canadian one since we're talking about Canada to begin. Great returns for a little bit more volatility. I think that over the long run, this is a better deal for clients than just market weight indexing for Canada and for the US and international. We do have another question. What happens to the distributions of the underlying? Manny, do you have a comment for that, or would you like me to?
Yeah, so both Canada and US dividend yields are sub 2%. We're going to pay it out basically whatever distribution is generated internally. We're going to pay it out on a quarterly basis. And if there's capital gains, just like any other mutual fund or ETF that's been embedded throughout the year, there's a consideration for year-end distribution. So the distributions, Sean, will be a variable distribution, and it'll be organic based on whatever dividends that are generated internally.
Okay, great. Last opportunity for questions if any of our audience members would like to type one in. Otherwise, we have a very capable sales team. You will be familiar with your wholesalers situated throughout the country, covering pretty much all the regions in Canada. Please reach out to them after this call if you have any further questions, and Manny or myself can get involved if it's an escalated question that needs to be answered.
Excellent. Thank you, Chris. And thank you, everybody, for joining. Have a wonderful day.
Thank you, everybody.